Something unusual is happening in the California housing market in 2026. And if you're even thinking about buying a home, this might be one of the most important conversations you hear this year. For decades, California real estate carried a kind of unstoppable reputation. Prices kept rising, demand stayed strong, and even when the market slowed down, it rarely stayed down for long. People believed that if you could just get into the market, you would eventually come out ahead. But today, that belief is being tested in ways that many buyers still don't fully understand. Before we go deeper, a quick disclaimer. This video is for informational and educational purposes only. It is not financial or investment advice. Real estate decisions depend on your personal financial situation, your goals, and the specific neighborhood you are considering. Markets can vary dramatically even within the same city, so always do your own research or consult a qualified professional before making any major decision. Now, with that said, let's take a closer look at the cities where buying a home in 2026 may carry more risk than most people realize, starting with number 1, San Francisco. San Francisco has long been one of the most iconic real estate markets in the world. Fueled by the tech boom, global investment, and limited housing supply, prices climbed to levels that seemed almost untouchable. But in 2026, the dynamics have shifted. Prices are still high, but the growth has slowed significantly. One of the biggest reasons is the shift toward remote work. Many high-income workers are no longer tied to the city, and that has reduced long-term housing demand in ways that are subtle but powerful. At the same time, the cost of ownership has reached extreme levels. Mortgage payments, property taxes, insurance, and maintenance can easily push monthly costs into territory that even well-paid professionals find difficult to justify. When you combine high prices with cooling demand, the risk becomes clear. Buyers may not see the kind of appreciation that defined the past decade. 2. Los Angeles. The issue is less about demand disappearing and more about affordability reaching a critical point. Los Angeles still attracts buyers from around the world, but the cost of buying a home has become overwhelming for many households. In some cases, buyers are stretching their finances to the absolute limit just to enter the market. Add in rising insurance costs, especially in wildfire-prone areas, and the total cost of ownership becomes even more unpredictable. When a large portion of buyers are financially stretched, the market becomes fragile. Even small economic shifts, like a slight increase in interest rates or a slowdown in job growth, can have a much bigger impact than expected. That's what makes Los Angeles a higher-risk environment in 2026. 3. San Diego. This is a city that continues to attract people because of its lifestyle, climate, and job opportunities. But desirability does not eliminate risk. In fact, San Diego is now one of the least affordable housing markets in the United States. Prices have risen sharply over the past few years, but wages have not kept pace at the same rate. This creates a widening gap between what people earn and what homes cost. Over time, that gap limits how many buyers can realistically enter the market. When fewer buyers can afford to purchase homes, demand begins to weaken, and that can slow price growth or even lead to declines in certain segments. 4. Sacramento. We see what happens when a market grows too quickly. During the pandemic, Sacramento became a hotspot for buyers leaving more expensive parts of California. Remote work allowed people to relocate, and Sacramento offered relatively lower prices. This surge in demand pushed prices up rapidly. But in 2026, that growth is starting to level off. Migration has slowed, and local incomes have not increased at the same pace as housing costs. This creates a situation where prices may have overshot what the local economy can support. When that happens, markets often enter a period of stagnation or correction, which can be challenging for buyers who purchase at peak prices. 5. Riverside. This city became a major destination for buyers looking for affordability. As prices in coastal cities rose, Riverside offered a more accessible entry point. But that demand drove prices up quickly, and now affordability is becoming a concern here as well. Many buyers in Riverside are highly sensitive to interest rates because they are already stretching their budgets. When mortgage rates rise, purchasing power drops, and that can quickly reduce demand. In markets that rely heavily on affordability-driven demand, even small financial changes can lead to noticeable shifts in pricing. 6. San Bernardino faces similar challenges, but with an added layer of economic complexity. The area experienced strong price growth in recent years, but job growth and wage increases have not kept up with housing costs. This creates a disconnect between what homes cost and what local residents can afford. As a result, the market often depends on buyers from outside the area. When demand relies heavily on external factors, it becomes more volatile. If those buyers step back, the market can lose momentum quickly. 7. Fresno. The situation highlights a common misconception that affordability automatically means safety. Fresno has historically been one of the more affordable housing markets in California, but prices have risen significantly in recent years. While that might seem like a positive trend, it becomes a concern when local incomes do not rise at the same rate. A strong housing market needs a strong local economy to support it. When that support is limited, prices can struggle to maintain their growth, especially during periods of economic uncertainty. 8. Stockton is a market with a history that many investors still remember. It was one of the hardest hit cities during the 2008 housing crash, and while the current situation is not identical, there are some similarities. Rapid price increases, combined with affordability challenges, create a situation where the market could be more sensitive to economic changes. Stockton serves as a reminder that fast growth does not always mean stable growth. Buyers need to consider whether current prices are supported by long-term fundamentals or short-term demand. 9. Oakland. The connection to the broader Bay Area plays a significant role. Oakland has often been seen as a more affordable alternative to nearby cities, but that relationship can also create risk. When demand shifts away from expensive urban centers, cities like Oakland can feel the effects quickly. Slower population growth, changing work patterns, and affordability pressures are all contributing to a more uncertain outlook. Markets that depend heavily on external demand can be more volatile when broader trends change. 10. Bakersfield. We see a market that attracts buyers primarily because of its lower price point. Compared to much of California, Bakersfield can seem like a bargain. But lower prices do not necessarily mean lower risk. The local economy is more dependent on specific industries, and population growth is relatively modest. These factors can limit long-term appreciation. For buyers, that means the potential for growth may not be as strong as it appears at first glance. Now, when you step back and look at all of these cities together, a larger pattern begins to emerge. The California housing market in 2026 is not collapsing, but it is clearly under pressure. The biggest issue is affordability. Home prices remain high across the state, while wages have not kept pace at the same rate. At the same time, mortgage rates are significantly higher than they were just a few years ago, which increases monthly payments and reduces buying power. But affordability is only part of the story. The total cost of owning a home is rising as well. Insurance premiums are increasing, particularly in areas with wildfire risk. Property taxes, maintenance costs, and utilities all add to the financial burden. Even if home prices remain stable, these additional costs make ownership more expensive over time and reduce overall return for buyers. Another important shift is happening in demand patterns. More people are leaving high-cost areas in search of affordability, either moving to other parts of California or relocating to different states altogether. This kind of migration can gradually reduce demand in certain markets, especially those that rely heavily on incoming buyers. At the same time, California still faces a housing shortage, which helps support prices at a broader level. This is why we are not seeing dramatic collapse across the entire state. Instead, what we are seeing is a more selective shift, where some markets remain relatively stable while others become more vulnerable. And that is really the key takeaway. Buying a home in California in 2026 is no longer just about getting into the market. It is about understanding risk. It is about looking beyond the surface and asking deeper questions about affordability, economic strength, and long-term sustainability. That does not mean you should completely avoid these cities. It simply means you need to approach them with caution and awareness. Look at local job growth, population trends, and affordability metrics. Consider how long you plan to stay in the home and whether the price you are paying makes sense over that time horizon. Because in today's market, the biggest mistake buyers can make is assuming that the future will look exactly like the past. The conditions that drove rapid price growth over the last decade are changing, and successful buyers will be the ones who adapt to those changes rather than ignore them. Take your time. Run the numbers carefully. Think about not just where the market has been, but where it might be going. Real estate is still one of the most powerful ways to build long-term wealth, but only when decisions are made thoughtfully and with a clear understanding of the risks involved. If you found this breakdown helpful, consider subscribing for more insights into housing markets, economic trends, and smart financial decisions. Staying informed can make a significant difference, especially in a market that is evolving as quickly as this one. Thanks for watching, and I will see you in the next video.